All right, guys, let's start. We're still waiting for a few people to join, but we can get started. So thank you so much for joining another Into the Blog webinar. Every 3 weeks we do these things and we try to cover sort of important aspects that we think are relevant to digital assets, particularly in DeFi and AI and the areas that we specialize on. Today, we're going to be talking about sort of the core, a topic that is very core to the DNA of our company and is also based on a recent thesis I published on CoinDesk related to the pillars of institutional DeFi. As always, I would like to start with a short update on Into the Blog. And we have, as we promised in the last one, we have some major news in case you haven't seen it. So Into the Blog is now called Centaura, and that's our fancy new logo. We completed a merger with one of our close partners, Trident Digital. We raised a 25 million Series A, and the two firms decided to come together almost 10 months ago to essentially build a universal layer for institutional DeFi. So we have been attacking the institutional DeFi problem from different angles. On the Into the Block side, a lot of quantitative strategies, risk management. We have over 3 billion in assets. Deploy mostly institutional capital. On the Trident side, a lot of capital formation programs, advisory deals, structure products, and we are both passionate about the role that DeFi could play in the next phase of crypto, but we think that in order for DeFi to be legit, it deserves a better institutional rail that today it really doesn't exist. We're some of the few companies doing this, so we decided to come together and raise a lot of money from institutional investors and go for it. So essentially, we're aiming to enlarge the pie of DeFi for the entire market. The company has a new management team, so I'm transitioning out of the CEO position into the blog to focus on product strategy and tech, which is really where my heart and passions are at. The Centaura is led by Trident CEO Anthony DiMartino, that has been a partner of us for the last 3.5 years, former Coinbase and Matrix Port executive, a friend, and somebody that we have done many deals together. So we got to know each other really well. Juan, our VP of Engineering, leads engineering. Alfredo, my co-founder at Into the Blog, is our new CFO. Lucas, who pretty much does 80% of these webinars, built our research desk with me when it was very controversial to invest time in research, and we built one of the best teams in the industry. Now transitioned to be our VP of Institutional DeFi. Basically took over my role. We have been working on that for a year. Julia, one of the co-founders of Trident, is our new COO. Toby used to be the head of structured products at Barclays and is our chief commercial officer. And Amir, that is a professor at NYU, is going to lead everything related to risk. As you know, we have an entire line of product focus on risk. So that is nothing changes on the mission. We just have a lot more resources to attack that problem. Vincent, who organized all this, is our VP of marketing, but somehow didn't make it to that deck. In other news, more tactical, recently we announced a partnership with Lombard, the biggest LRT on Bitcoin. So we launched a Centaura Lombard Vault that is capturing a large part of the capital that was sitting on chains like Chain. Is in the hundreds of millions, so it's very sizable. A large portfolio, about 50 strategies, paying about a 6% APY. So a very good offering for Bitcoin holders right now. And our risk product launched the Uniswap V3 coverage. So you can check it out. So go to the risk radar and you can see the risk signals and the alerts for Uniswap V3. That's all in terms of an update. So what we're going to cover today, and I recently summarized a lot of this in a recent article in CoinDesk, but we're going to be talking about DeFi ecosystems beyond formation, beyond incentive, right? Like how do every ecosystem struggles with deploying incentive, and then what happens? So we have an entire thesis of how to build robust DeFi ecosystems, and we're gonna talk about the key challenges with ecosystem formation, how to build robust DeFi ecosystem beyond incentive, and something that what we call institutional grade DeFi, that is institutional capabilities, but for everybody. Is the core thesis of Centaura, is what we did this merger with Trident, and it's a key foundational block that we think is missing in DeFi today. Into the block did its part to build that, Trident did its part, and now we came together. So let's start with this. What everybody knows is, right? A cold start problem in DeFi. You're launching in the last couple of years. We have seen a tremendous amount of new ecosystems coming to market, but attracting capital and protocols and all that to that is really hard, right? Nobody knows who you are. Like the money that you have is the money that you've raised. How do you build an ecosystem? And the formula for that has been incentive. Now, incentive were very successful in 21. But after that incentive bonanza expired, then we saw ecosystems like Polygon decline quite a bit. Even ecosystems like today are thriving, like Avalanche. They have quite a bit of hiccups, and there were others that entirely disappear. So today, a lot of chains rely on incentives. So Berachain, Tom, Plume, a lot of those, and that brings echoes from the 21 era. And then the crucial question is, okay, when incentives expire, so when they end, how sustainable is this? And that is a question that is in the mind of every DeFi ecosystem, protocol, or blockchain that is coming to market. So DeFi B, what we call DeFi B2, that is this way of DeFi, is very different. So the incentive problem still stands, right? But there are other problems that we need to consider, because the DeFi summer of 21, there was nothing, right? And all these protocols were the first wave. But now we're seeing a different set of problems, right? There is a massive proliferation of DeFi ecosystem protocols and ecosystems being launched like we never seen before. It's too many. The number of investors is not growing at the same pace, and we're going to see that. There is a massive amount of TVL fragmentation. We're going to show you clearly that the bulk of the TVL in DeFi is institutional and whales, despite of this mysticism around retail participation. And then a lot of these ecosystems, and we know this because we deploy capital, so we suffer through this, is very inefficient, right? The configurations lead to a lot of risk and inefficiency. So let's break it down one by one. So one of the problems that we have today is there are too many blockchains. There is a blockchain for everything. And there are not that many protocols. So it should be the other way around, right? There should be less blockchain than protocols, but the protocols that matter are a handful. And we keep launching chains and chains and chains, and all those chains are competing for the attention of the same protocol, which this creates an immense amount of fragmentation, right? And obviously, if you get Aave on your chain, you have, or Euler or Morpho, or any of these, Uniswap, any of these marquee protocols, you're doing pretty well. If you don't, then it's really hard to convince allocators at a scale. Probably an even bigger problem here is that my partner Anthony likes to say this phrase that he said, we haven't created any new degens in this cycle. What this expresses is the fact that the ecosystem is growing faster than the number of investors. So it should also be the opposite. So the participants in DeFi, the TVL, should grow faster than the infrastructure. But we keep growing infrastructure, launching new chains, new protocols, And then those come with a lot of onboarding friction. Bridges are difficult, wallets are difficult. You need to do a lot of swapping and things like that. And what that creates is a tremendous amount of capital fragmentation. That wouldn't be a big deal if it's just user experience, but the problem is that it leads to risk, because ecosystems with a small amounts of capital are very susceptible to exploits and things like that. Then the TVL fragmentation, so breaking that down a bit, is DeFi TVL is not growing as fast as the ecosystem. Everybody's chasing the same liquidity providers, right? We're a beneficiary of this because we have a large institutional distribution. So we're in the somewhat privileged position that a lot of ecosystems come to us and we can work with them to deploy capital. But reality is that the capital is not growing fast enough, right? That's part of the reason we feel we needed to create a bigger company to attack this problem. And it's very fragmented. And fragmentation leads to slippage, leads to all sorts of risk conditions. Then our research team that now has a new VP of research, Juan Pellicer, that I used to work with, Lucas, recently published a paper that sort of proved very quantitatively that DeFi, the adoption in DeFi is mostly whales or institutional, like big allocators. So there is this mystic persona in DeFi, the retail investors and ecosystems, what a lot of retail. But what you're seeing here is a chart that illustrates that the top 100 depositors in Aave control 85% of that market, the biggest protocol in DeFi. So a lot of the capital comes from large allocators, but the rails are designed for retail. So this is a tremendous mismatch. What that means is that there is no proper security compliance, the robustness that you expect as being a large allocator. So we have a product for the run audience, for the run user. So that's a problem that needs to be solved. And then a lot of protocols, when they launch quickly and ecosystems, the incentive programs, even if they attract capital, we find a lot of times that they're not properly configured, so it leads to a lot of inefficiency. So there are a lot of trades that can be executed because you incur a lot of slippage, but if the balance of certain pools was different, that could be easily solve, and all this end up in a massive amount of capital going to the whales and the VCs that invested in those deals. So it's completely asymmetrical. So how do we solve this? How do we fix this? And there is a series of first principles here that we like to apply and work with the ecosystems that we partner with. So you need to build an ecosystem that post-incentive, there is utility, right? So you need to engineer that utility. You need to use incentive to bootstrap that initial activity, but you need to start engineering organic trades that are going to survive that, namely lending and swapping and things like that. And there are ways to do this. So there are a few things that you should take into consideration. For instance, stable coins is key, right? So having a stable coin as part of your ecosystem is good. Having two is what we advise, right? Because two major ones, because with two, you can create a lot of borrow lend mechanism. You can create a stable pools. You can get in and out of trades in a more efficient way. So typically, if you get, USDT and something like a Ripple stable coin and something like that, is a really, really powerful combination. In addition to that, you need liquidity in major assets. So why? Because what does dominate the market cap? So Bitcoin and ETH as the top, and some of the top 10 are interesting to assets to support, because that enables, if you can offer yields that people supply Bitcoin, borrow stables, deploy those stables, it unlocks yield in Bitcoin, you attract Bitcoin that way. But also you should consider that a lot of the capital sitting on institutions is on Bitcoin and ETH and stables. And sure, Solana and AVAX and other things, but those three dominate. So if you can unlock rails for that, you're in a much better position. Then one recipe that is key is to build DEX liquidity, AMM liquidity. Why? Because when you enable DeFi trades, and you need to exit, most of the time you need to swap out of a position. And if you don't have enough liquidity, you're stuck. So being thoughtful about how to, so for instance, our team recently have the privilege of partnering with Ripple on the Ripple stablecoin launch. And this was carefully engineered to have DEX liquidity in Curve, then launch Aave, that was a phenomenal partner, and then we're launching other protocols. But if I wanted to get out of a trade in Aave, I have that liquidity in Curve rather than having to go through a centralized DEX. And complementary to that, you need lending market coverage, debt, but also wide coverage, so different assets. Why? Because there are many assets at Bitcoin that are non-yield friendly, but if you can enable borrow lends, I can earn yield on my Bitcoin by borrowing ETH or stable coins and deploying those and manage the risk. And also because there is a new wave of product coming in the form of RWAs, and the canonical trade with RWAs is going to be supply a tokenized asset and borrow stables and deploy those stables. So you need a lending market coverage for this. Then one that is completely ignored and is essential for institutional adoption is institutional custody integration. So Fireblocks, for DeFi, BitGo, like integration with these platforms. Why? Because the institutional capital is sitting there. All the whales, everybody that has certain amount of capital in crypto is sitting with a large custody platform. So having a seamless bridge from that platform to the DeFi activity is super, super important. And many times, more often than not, this is the last item on the agenda, and it takes a lot of time. And without that bridge, you cannot really do a lot. And speaking of bridges, that meant to be not a bridge, but bridge. Having a solid bridge infrastructure, having layer 0, wormhole, Axelar, some of the big bridges as part of your ecosystem helps a lot, because those guys have been battle tested at a scale that most bridges are having. And obviously bridges are one of the main attack vectors on any DeFi ecosystem. So having that level of robustness and interoperability is very important. Then there are others that are not that tangible, like oracles, having proper oracles like Redstone or Chainlink to avoid exploit, partnering with the right market makers for liquidity, balancing the pools, avoiding unnecessary slippage, and also doing the work to attract high quality protocols. There are a couple of questions here, or I guess one, somebody said that institutions would rather invest in centralized project rather than DeFi. We're not talking, so in terms of deploying capital, you will be surprised. We have 3 billion to prove otherwise, but there is a lot of DeFi is gaining momentum as a parallel financial system, and there is a tremendous amount of attention for institutions into DeFi, and DeFi is not going anywhere. I think exchanges already proved their case. DeFi looks really good right now. We have a president in the US that likes DeFi. So I think DeFi is here to stay, and it's going to have more institutional rails sooner rather than later. So you do all this, and it still might not be enough. And this is what we call the institutional grade DeFi thesis. And we call it institutional grade and not institutional because we think DeFi is meritocratic and it doesn't require clubs, and it should be available to everyone, right? But you need the level of robustness that a large crypto institution or a bank or an asset manager should have. That's why we're building this, right? To make it programmable, to make it composable. And a lot of those primitives are missing. I could go on this for 2 hours, but we tried to run these webinars in 30 minutes. So I tried to summarize this in 5 key pillars that I think this need to be attacked like yesterday. 2 technical and 6. So 2 technicals and 4 financials. On the technical side, user experience has to get better. And it's not only a UX problem, and also interoperability. And then we're going to talk about a few financial primitives that we think are missing, and we're working on some of them. So The technical, the UX perspective, I'm not really talking about having a beautiful wallet and all that. I'm talking about the experience of deploying into a new DeFi ecosystem. Is the bridges, the wallets, the swapping experience to get into an asset. It's too many friction points. So this thing needs to be abstracted behind yield bots that is one click and go deploy, and this magic happens. If not, we're gonna keep backpedaling through this issue. Interoperability is also important because capital is very fragmented. So having activity that could leverage capital from different chains unlocks a lot of interesting use cases. So much so that protocols like Aave before are making that cross-chain capital access like one of their core features, because this is a massive problem today. Now, when we go into financials, so double clicking on this, so yield abstraction today, in 2021, it was very easy to obtain yields in DeFi. You could deploy into a pool by 20%. That's not the case anymore. You have to be, most yields are in things that combine different protocols, like it should be. You need to exploit inefficiencies in markets, and doing that is technically very complex. So expecting normal users to do that, forget it. So you need to create that layer of that abstract the complexity. Then risk management, obviously, it has gotten way better. Like there are fewer and fewer hacks, but continuing to build on that is very important. We have an entire product dedicated to risk monitoring. And we're gonna keep attacking that problem. Then structured products. This is again one of the reasons we merged with Trident, because they're really exceptional in this area. So DeFi, by doing AMM and lending, you can only get so far. So in order to serve a broader financial ecosystem, you need better structuring. You need products that combine margin, that combine insurance, that combine lending, so that I can issue a loan to a third party, deploy here, use leverage for that. And in order to do that, you need pros that abstract all that complexity. And then we're obsessed with this problem. We think insurance is the missing primitive in DeFi. We have an entire research effort on this. We have attacked this problem twice and failed. And we keep going at it because we think that this has to be built. It's the ultimate form of risk management. So, and the minute insurance is taken care of, it just unlocks massive amounts of capital into DeFi, and there hasn't been a relevant financial market in history in the last hundreds of years that hasn't had an insurance component of it. So this has to be done. I don't know who's gonna do it, but this has to be solved. So there are other things right now that are interesting. So there is an entire trend around RWS to DeFi. I think that's interesting. If you follow what Securitize is doing with Converge, what Plume is trying to do, I think there's some interesting ideas. Derivative in DeFi, we need more hyperliquids, right? Like we need more projects like that. The CeFi DeFi integrations, we're beneficiaries of that fragmentation because we run a lot of arbitrage on CeFi DeFi, but I mean, this has to go seamless, integrated. I think efforts like Base with Coinbase and Inc with Kraken are probably good steps in that direction. And then ultimately, right, DeFi we need to expand the market, right? It's not a crypto thing. We need the banks and the asset managers and the insurers and the participants in traditional finance to use DeFi as another financial system. It doesn't need to replace anything they do. So that's all I have. I'm shocked that I did this in 25 minutes. I wanted to thank you. I'm going to go to questions, but before that, I wanted to announce the next webinar. So, 3 weeks from now, June 18, our new head of research is going to be talking about risk-taking, but it's going to be talking about risk-taking as from a different angle. That is a way to evaluate risk and rewards in DeFi. The link is there in the Q&A, so you can go sign up. Please, there is a few questions here. So somebody asked, how is liquidity fragmentation impacting institutional capital? Is very easy. As you're a large institution, you're looking to deploy 50, 100, 200 million into an ecosystem. If the ecosystem has very few a small liquidity, that escalates the risk to tremendous levels. So most likely that's a major blockers. Somebody asked, there is a question on Solana I didn't understand. Federico said TradFi will soon merge with DeFi, hybrid concept. DeFi ecosystem provided technology advantage. Yeah, I don't know. Like, I don't. We don't need to be that ambitious. I think there is a lot of merit on just running DeFi as a parallel financial system that brings its own merit, has its own use cases, and interopts very well with TradFi. And I think that's a very, very good next step. We don't need to. It doesn't have to be like a unified thing, but hopefully we'll get there. Lauren is asking, what kind of insurance cases would you like to see? Look, I mean, I think the white whale is hacks, right? Technical. That's the one everybody wants to see. The thing with this, and again, we can go. Very soon we're gonna be discussing. We're gonna have a webinar just for insurance. But the thing with hacks is very binary. You lose everything or not. So it somewhat defies the traditional insurance, statistical insurance models. But there are ways in which this can be attacked, right? And again, we had 2 attempts at this and didn't see a solution. But we have an active. It's an area that we actively research. The good thing is everybody and their mother agree that this is a massive problem. So you don't need to convince anybody that insurance is needed. Billy is asking, what type of a structured products do you expect to see the highest demand? So I have a couple that we deal with often. So there are many regulated institutions that cannot face DeFi directly, but they're perfectly cool with lending to a third party that faces DeFi. So if you package that in a single trade, that's compelling. There is also a lot of unfriendly DeFi assets, like even major projects like WorldCoin and all that would like to earn yield. And the way to earn yield is to borrow stables or ETH or things like that, but you're gonna borrow in DeFi. So if you package that through a traditional lending desk, that's also interesting. There is all sorts of structures with derivative for protection that also makes sense. Wow, this is a very, very long text from Andy. So what are the main reasons? So I'm trying to summarize it. What are the main reasons DeFi protocol haven't adopted closed loop membership based on investment model? So look, there have been attempts to this, notoriously Aave Arc, right? Like they tried this really hard. It didn't work, meaning you needed to KYC and things like that. There is a combination of things there. By the way, Aave is back at it with Aave Horizon, so Stan is not giving up on this idea. But I think KYC ML creates a friction. I published a paper years ago saying there are ways to attack that problem that doesn't have to negate what DeFi is about. Like if you think about what a KYC is a statistical sampling of something that gives you a score that said, hey, you're good to go or not. So you can do that with on-chain data and tell you this pool is relatively safe or whatever, we do that. But I think that creates a friction, but it has to be solved. Now, we have been also looking at this problem in a more detailed way, and there are a lot of nuances. So it's not as crazy as everybody has to be KYC and all that. There are ways to have a middle ground solution there. But I think that creates a friction. And then if you create a product only for institutions, when this was attempted in 21, there were not that many, so it didn't. But maybe now there is a chance. One intersection that I'm very interested on, that is Tony Irwin asked this question, is that intersection of RWAs and DeFi. So that might be one that in which KYC plays a role, right? Like, what Securitize is doing. Like, I can put my tokenized asset, I can borrow stables, I can deploy those. There is another question. How is the interest of institutions to explore synthetic assets in DeFi? Not sure what you mean, because there is like 1 million of synthetic assets in DeFi, but there's including RWAs and things like that. There is even some attempts that I think are gonna be quite interesting, in which in creating synthetic assets for keeping liquidity in custody and using the synthetic representations in DeFi protocol, and not having to be paying gas in every transaction and things like that. So it's interesting. Jorge Alberto asks, what about BlackRock and PayPal? They are DeFi, or would be, well, look, PayPal has PyUSD. PyUSD is in DeFi. We know that because we have done a ton of trades with that. And BlackRock, TBD, I cannot speak for them, but obviously they're big on RWA with Beatles. So I think eventually all these guys will come in. Elizabeth asked that she agreed that UX is the biggest hurdle, but it's a very long test, right, guys? Yeah. Yeah, so there is, so she brings up like a very important point. So there is a major friction in terms of creating abstraction for simplicity and the transparency that you get with DeFi. So it's another way to say is what she tried to say in this long text. So of course, if I bundle everything in a structured product and you don't see what's happening underneath, that is a problem. But what if you could see what's happening underneath, right? What if it's a structured product that is on chain and you can see that behind this or these three trades, and you can trace everything on chain? So it doesn't have to be. I know I gave the example of centralized lending desk, and so yeah, that's a gray area, and I know that's, that might be. There are some people that are going to be religiously opposed to that. We looked at it from a more practical lens, that it is where the liquidity is. We need that to unlock some trades, but and 99% of what we do is 100% on chain. So there are even within the full on chain ecosystem, there are structured products that are needed, like hedging and things like that. Let me see if I'm missing anything. So there are a couple of promotional points there. And some people saying thank you. So thank you very much for joining. And with that, I would like to thank you guys very much for joining. Go follow Centaura, go register for the next webinar. It's going to be a lot of fun, and we'll love to see you on the next one. So thank you very much.